Let's talk about something that makes most people's stomachs drop, a market crash. But you know what? The whole point of this explainer is to flip that fear on its head, because when the markets go red, it isn't just a crisis. It's a massive, once-in-a-decade window of opportunity. Let's dig in.
Look, you hear it all the time, right? Pundits are always pointing to signs, inflated prices, crazy debt levels, but nobody, and I mean nobody, can predict the exact timing. The only thing we know for sure is that a correction will happen. So the real question isn't if or when, it's are you going to be ready?
Because when that moment finally hits, the investing world splits right in two. You have 99% of people who are going to react with pure fear. They'll sell everything, locking in huge, devastating losses. But then there's that other, much smaller group, the prepared investors. And they see the chaos for exactly what it is, the single greatest chance to build wealth.
All right, so let's jump into section 1, a crash is coming. Before we can talk about how to take advantage of it, we've got to get our heads around one core principle that honestly changes everything.
This is probably the most important idea in this whole explainer. During a downturn, wealth doesn't just disappear into thin air. Nope, it moves. It literally flows from the accounts of the panicked and the unprepared over to those who are patient, disciplined, and have a plan. Your only job is to make sure you're on the right side of that transfer.
So how do you get on the right side? Well, first, you have to understand the traps that guarantee you'll land on the wrong one. And that brings us to section 2, the 3 cardinal sins. Because, funny enough, the plan for getting rich in a crash is less about what you do and way more about what you don't do.
Okay, these are the 3 big ones. These are the mistakes that absolutely crush the average investor. Number 1, selling out of pure fear. Number 2, trying to be a hero and guess the market's absolute lowest point. And number 3, thinking that hiding out in cash is going to keep you safe. Let's break down why each of these is a total disaster.
So, the biggest mistake by far is panic selling. And to really get why, you need to know the difference between 2 kinds of losses. When your portfolio is down, that's what we call a paper loss. It's just theoretical. You haven't actually lost anything yet. The loss only becomes real and permanent the second you hit that sell button.
Think about it like this. Think of your investments like your house. If the housing market in your neighborhood takes a dip, have you lost money? Not really, right? Not unless you freak out and sell your house for that lower price. If you just keep living there, you give it time to recover. Selling your stocks in a crash is basically like running out of your house during a hurricane and taking the first lowball offer you get.
And this leads us right into the second sin. So some people manage to avoid panic selling, but then they fall into a different trap, the genius trap. They think, oh, I'm smart. I'll just wait for the absolute perfect bottom, and then I'll dump all my money in. But seriously, can anyone, even the pros on Wall Street, consistently do that?
The data here is just crystal clear. Trying to time the bottom is a fool's game. You know, the market's best days often happen right after its absolute worst days. Research shows that if you were invested for the last 30 years, but you missed just the 30 best trading days, your average return would have tanked from over 8% a year all the way down to just 2%. The risk of missing the rebound is just so much bigger than the reward of trying to time it perfectly.
And that brings us to sin number 3, hiding in cash. I get it. It feels safe, right? Your bank account number doesn't go down, but this is a complete illusion. While you're sitting there on the sidelines, you've got 2 silent wealth killers working against you. First, inflation is eating away at the buying power of your money every single day. And second, you're missing out on the swift market recovery, which almost always happens when people least expect it.
Okay, so we know what not to do. No panic selling, no trying to time the market, and no hiding in cash. Got it. That brings us to section 3, the simple wealth plan. This is our playbook for what you actually should be doing.
You know, the entire strategy really just boils down to this timeless piece of wisdom from Warren Buffett. A market crash is the moment of absolute peak fear out there, and for the investor who's prepared, that's the ultimate green light. That's the signal to get greedy.
This right here is the single most critical mindset shift you have to make. You have to stop seeing a market crash as a crisis and start seeing it for what it is, a massive store-wide sale. Think about it. When your favorite store announces a 50% off event, you don't run away screaming, do you? No, you get excited. This is exactly the same thing. The world's greatest companies are on sale at a huge discount.
So how do you actually take advantage of this sale? Simple. You automate your discipline with a strategy called dollar cost averaging. All it means is you invest a fixed amount of money, let's say $500, at a regular time, like every single month. You set it up once and you forget it. This takes emotion and that dangerous temptation to time the market completely out of the equation.
And here's why this is so unbelievably powerful. When the market is flying high, your $500 buys you, say, 10 shares. But now, look what happens when the market crashes and the price gets cut in half. That exact same $500 now buys you double the shares. You are automatically, systematically buying more of an asset when it's cheap. Over time, this just hammers down your average cost and fuels your returns when the recovery inevitably comes.
Okay, but what are you buying? For this simple strategy, the answer is not trying to pick the next Amazon or Google. That's an incredibly difficult game to win. Instead, you just buy the whole market through a low-cost index fund or an ETF. These are basically just baskets that hold hundreds of stocks all at once.
And this is why it's so brilliant. With one single purchase of, say, an S&P 500 ETF, you are instantly invested in 500 of the biggest companies in the country, across technology, healthcare, financials, all of it. Any single company could fail, sure, but you're not betting on one company. You're making a bet on the long-term resilience and innovation of the entire economy, and that's a bet that has always paid off.
So let's wrap this all up in our final section, building your fortress of discipline. We've seen that the simple way to use a market crash to get rich, it has nothing to do with risky bets or complicated charts. It's all about having a clear, simple plan and just sticking to it.
Here it is, your entire playbook all on one slide. On the don't side, you stay away from the 3 cardinal sins. No panic selling, no market timing, no hiding in cash. And on the do side, you reframe your mind to see a sale, you automate your plan with dollar cost averaging, and you buy the whole market. That's it. That's the whole game. At the end of the day, the difference between the people who lose a ton of money in a crash and those who build a fortune, it isn't about being smarter or having some secret information. It's just about having a simple, logical plan and, maybe most importantly, having the discipline to stick with it when everyone else is running for the hills.
By getting ready now, you can literally transform a moment of public fear into your own private opportunity. So I'll just leave you with this question to think about. What is your single biggest fear about a market crash? Answering that question for yourself, that's the very first step to building your fortress,